Welcome to the Ring of Knowledge, your trusted source of financial and practical knowledge. Cryptocurrency is a revolutionary technology that has taken the world by storm in recent years. Bitcoin and Ethereum are two of the most well-known and widely used cryptocurrencies, but despite their similarities, they have some significant differences that set them apart. From their technical design to their consensus mechanisms, understanding these differences is critical to making informed decisions in the world of cryptocurrency. In this video, we will delve into the similarities and differences between Bitcoin and Ethereum, explore their consensus mechanisms, and explain how they work. Whether you're an investor or simply curious about the world of cryptocurrency, this guide will help you to gain a better understanding of Bitcoin versus Ethereum and equip you with the knowledge you need to make informed decisions in this exciting and rapidly evolving industry. So let's dive in. Overview: Bitcoin versus Ethereum. Bitcoin and Ethereum are two of the most well-known and widely used cryptocurrencies in the world. While they share some similarities, they also have some significant differences that set them apart from each other. Bitcoin was the first cryptocurrency to gain widespread popularity and is often referred to as the digital gold. Its main use case is as a store of value and a medium exchange. Bitcoin's supply is limited to 21 million coins, and it uses a proof-of-work consensus algorithm, which is a way of verifying transactions and adding them to the blockchain. Ethereum, on the other hand, is more than just a cryptocurrency. It is a decentralized platform for building decentralized applications, or dApps, using smart contracts. Ethereum's native currency is Ether, which is used to pay for transaction fees and other services on the network. Unlike Bitcoin, Ethereum has no hard cap on its total supply, but it does have an inflation rate that decreases over time. Ethereum uses a proof-of-stake consensus algorithm, which is more energy efficient than Bitcoin's proof-of-work algorithm. One of the most significant differences between Bitcoin and Ethereum is the way they handle transactions. While Bitcoin transactions are generally simple and straightforward, Ethereum transactions can be more complex as they can involve executing smart contracts. Smart contracts are self-executing contracts with the terms of the agreement between buyer and seller being directly written into lines of code. Another key difference is the way in which the two cryptocurrencies are used. Bitcoin is primarily used as a store of value and a medium of exchange, whereas Ethereum is used to power decentralized applications and protocols. This means that while Bitcoin has a more limited set of use cases, Ethereum has a much broader range of potential applications. Overall, Bitcoin and Ethereum are both valuable and important cryptocurrencies, but they serve different purposes and have different strengths and weaknesses. Bitcoin's focus on store of value and simplicity, and Ethereum's focus on smart contracts and decentralized applications make them complementary in the world of cryptocurrency. Bitcoin. In January 2009, the world of finance and technology was forever changed with the launch of Bitcoin. Conceived by the enigmatic Satoshi Nakamoto, Bitcoin introduced a groundbreaking concept in its white paper: the idea of a digital currency that is free from the control of any central authority, unlike traditional government-issued currencies. Unlike physical currency, Bitcoin exists only in the form of electronic balances that are linked to a cryptographically secured public ledger. The underlying technology that enables this decentralized system to function is known as a blockchain. Although Bitcoin was not the first attempt to create an online currency, it quickly emerged as the most successful in its initial efforts. In fact, it is widely regarded as the forerunner to almost all other cryptocurrencies that have since surfaced in the past decade. Despite its rapid rise to prominence, the virtual, decentralized nature of cryptocurrency has often faced resistance and skepticism from regulators and government bodies. Despite this, cryptocurrency has persevered and managed to carve out a unique place for itself within the financial system, coexisting alongside traditional currency despite scrutiny and debates around its legality and legitimacy. While not yet formally recognized as a medium of payment or store of value, the widespread acceptance of cryptocurrency is gradually increasing, hinting at a promising future for the technology. Ethereum. Blockchain technology is rapidly evolving, extending its reach beyond its origins as the backbone of digital currency. In the field of decentralized software platforms, Ethereum has emerged as the largest and most well-established player since its launch in July 2015. The beauty of Ethereum lies in its ability to facilitate the creation and deployment of smart contracts and decentralized applications, or dApps, free from the clutches of any third party. This is made possible by Ethereum's blockchain-based infrastructure, which is specifically designed to operate without downtime, fraud, control, or interference. An essential feature of Ethereum is its custom programming language that operates on a blockchain. This capability opens up a world of possibilities, allowing developers to create cutting-edge dApps and smart contracts for a wide range of applications. Fueling the decentralized ecosystem of Ethereum is its native cryptographic token, known as Ether. Ethereum launched a pre-sale of Ether in 2014, and the response was overwhelming. Since then, Ether has been put to use in a variety of ways. It is traded as a digital currency on exchanges, held as an investment, used to purchase goods and services, and also used on the Ethereum network to pay transaction fees. Bitcoin versus Ethereum. Similarities. The world of cryptocurrency is always changing, and there are a plethora of different blockchains to choose from. However, two blockchains have consistently risen to the top and captured the attention of investors and traders alike: Bitcoin and Ethereum. Despite their differences in technical design, these two blockchain giants share a key similarity: their widespread adoption and massive user base. One of the primary reasons for the success of these two blockchains is the fact that they have more users than other cryptocurrencies, making them the two most valuable cryptocurrencies by market capitalization. While Bitcoin has been around longer and has more institutional adoption, Ethereum has carved out its niche with a larger active user base and transacts far more volume than Bitcoin on a daily basis. These two cryptocurrencies have established themselves as leading players in the industry, and their staying power is indicative of their strong network adoption. The widespread adoption of Bitcoin and Ethereum can be attributed to a variety of factors. One of the key drivers of their popularity is their ease of use, which has enabled individuals and businesses alike to transact with these cryptocurrencies with relative ease. Additionally, their decentralized nature and secure blockchain technology provide a level of trust and transparency that has helped to foster their widespread adoption. While Bitcoin and Ethereum differ in their technical design, they share a critical similarity in their widespread adoption and staying power in the cryptocurrency industry. Bitcoin versus Ethereum: technical differences. The consensus algorithms used by these two digital currencies differ. Bitcoin uses the SHA-256 algorithm, which is a computationally intensive hash function, while Ethereum uses LMD Ghost, a more advanced proof-of-stake algorithm. While SHA-256 provides Bitcoin with a high level of security and resistance to fraud, the LMD Ghost algorithm used by Ethereum ensures that transactions are confirmed more quickly. While both Bitcoin and Ethereum are cryptocurrencies that leverage distributed ledger technology and cryptography, their technical differences are substantial. These differences impact how transactions are processed, the speed at which they are confirmed, and the level of security and fraud resistance. In essence, these differences make each cryptocurrency unique and ideally suited to specific use cases. What is a consensus mechanism? A consensus mechanism is a critical component of blockchain technology that ensures its viability. It is a computer algorithm that helps prevent the double spend problem, which is a central challenge that could undermine the integrity of the network. The double spend problem is similar to having a $10 note that you can't spend twice because once it is spent, it no longer belongs to you. On the other hand, Bitcoin, or BTC, is a digital asset represented by a string of computer code that can be copied infinitely. This means that if you make a copy of your BTC, you could potentially spend it over and over again, making yourself infinitely rich. However, the consensus mechanism prevents this from happening. When you send someone a BTC, the copy of that BTC you had is destroyed and a new version of it is created in the recipient's account. This entire process is recorded on a distributed ledger for everyone to see. Since every ledger holder can see that you have spent your BTC, you cannot attempt to spend a copied version of it. Otherwise, the consensus of ledger holders would be that you are trying to deceive them. It's difficult to tamper with a single transaction. But even if someone does, they would need to alter every subsequent transaction since each one refers to its predecessor. This would require an enormous amount of computing power, effort, and control of 51% of the distributed ledgers on the network to get the consensus necessary to etch your fake history of transactions onto the blockchain and take your freshly mined cryptocurrency as a reward. Proof of work. In the world of blockchain technology, a popular method of reaching consensus is to employ a complex mechanism that tasks participants with carrying out intricate computations, offering the chance to validate a group of transactions and subsequently adding them to the blockchain while earning a fixed amount of cryptocurrency as a reward. The work involved in this process entails attempting to correctly guess a unique 64-character alphanumeric string, a task that presents a mind-boggling number of possible combinations, thereby making it a Herculean feat for anyone without the most powerful computing hardware. The more potent the hardware, the higher the number of guesses that can be made per second within a brief 10-minute time frame, resulting in an increased chance of becoming the selected validator. The consensus method is designed to prevent fraud by necessitating that anyone wishing to tamper with the ledger and have their own version added to the block must possess at least 51% of the computing power on the network. Achieving this would require an astronomical amount of resources, rendering fraud an almost impossible feat. Proof of stake. Ditching the need for complex computations, the consensus mechanism of proof of stake employs a novel approach by encouraging participants to stake their own money as collateral, affording them the opportunity to validate transactions and append blocks to a blockchain. Participants with a higher stake in crypto have a greater chance of being chosen to validate transactions, thereby earning a fixed amount of cryptocurrency. The system puts a premium on financial power, granting an upper hand to those who can stake more funds. The beauty of the proof-of-stake consensus mechanism is that it discourages malicious actors by imposing hefty financial penalties on any violators. This mechanism creates a blockchain system that can withstand tampering attempts by requiring that anyone seeking to add fraudulent records to the blockchain must control at least 51% of the total stake in the network. Unlike the power-hungry proof-of-work method that relies on powerful computer hardware, proof-of-stake is considered a more environmentally friendly consensus mechanism that uses significantly less energy. This eco-friendly alternative has garnered immense interest as it allows for a more sustainable approach to blockchain technology, in addition to creating a more inclusive and accessible platform for participants of all backgrounds. As we wrap up our discussion on Bitcoin versus Ethereum, it's important to note that while they may have their differences, both of these cryptocurrencies are integral to the world of blockchain and have their unique strengths and weaknesses. Bitcoin's focus on being a store of value and medium of exchange, combined with its simplicity, makes it ideal for those looking for a decentralized payment option. On the other hand, Ethereum's focus on smart contracts and decentralized applications, combined with its more energy-efficient proof-of-stake consensus mechanism, makes it ideal for those looking to build and use decentralized software. Both Bitcoin and Ethereum have helped pave the way for the adoption and growth of cryptocurrency, and their impact on the world of finance and technology will continue to be felt for years to come. We hope you found this video informative and gained a better understanding of the similarities and differences between these two prominent cryptocurrencies. Thanks for watching.